This is Ash Heatwool, Director of Wealth Management at Graves Light Lenhart. Based on the positive feedback received from many of you, we are opting to communicate via video not only for our quarterly newsletters, but also for our shorter monthly updates in between. The purpose of these short monthly updates between quarter end is to provide insight as to what we've observed in the markets during the prior monthly period, while also pointing out a useful takeaway or trend which we've observed in the form of a chart of the month. We continue to welcome further feedback from our clients. On the right side of the slide is a performance table which provides returns across major asset classes for the month of August, quarter to date, and year to date. You'll see that for the month of August, equity returns were mostly negative as domestic stocks took a breather from their year-to-date rally despite a strong recovery in the latter part of the month. While inflation in the U.S. continues to moderate, interest rates moved higher as the path of rates as well as Fed policy going forward remains highly uncertain in light of recent economic performance. In short, while the Federal Reserve has rapidly increased the Fed funds rate since early last year, the economy has remained more resilient than the markets have anticipated. The resilience suggests that the Federal Reserve could very well maintain its restrictive monetary policy stance for longer, which essentially means interest rates also remain higher for longer. As interest rates increased across multiple points on the Treasury yield curve, performance for fixed income was generally negative, particularly for the more rate-sensitive parts of the bond market. Notably, the 10-year U.S. Treasury rate increased to over 4.3% during the month, something the bond market has not witnessed in nearly 15 years. This is our chart of the month. The data is compiled by Bloomberg, with the black line indicating the number of bankruptcy filings domestically and the blue line reflecting credit spreads for the U.S. high-yield market, commonly referred to as junk bonds. As a reminder, credit spreads represent the level of compensation which investors are receiving to bear the inherent default risk within the high-yield market. As junk bond issuers carry lower credit ratings than, say, investment-grade issuers, the high-yield market has historically provided higher levels of income to compensate investors for this risk. At a high level, the greater the default risk, the higher the credit spread. Interestingly, while the number of business failures has spiked in 2023, high-yield credit spreads have actually compressed over the same time period and remain well inside long-term historical averages. So why the disconnect? There are a few regularly cited reasons, namely that the high-yield market has improved in overall quality over the last several years, as well as the fact that the overall high-yield market has actually shrunk in nominal size. Perhaps most importantly is that high-yield issuers largely issue fixed-rate debt, hence being able to lock in lower rates prior to the Federal Reserve aggressively raising interest rates to tamp down on inflation. As a result, while default rates in the high-yield market have increased over the last 12 months, they remain relatively low given the limited amount of debt coming due this year. This being the case, we are increasingly wary of default rates continuing to rise in the high-yield market and are increasingly cautious on the asset class given the waning level of compensation to bear the risk of default. Thank you for your time and interest. As always, please let us know if you wish to discuss these items or any other issues related to your financial planning needs. We are here to help.